Good morning, happy Tuesday, and welcome to today's edition of Toggle's Daily Video Insights. My name is Jan, I'm the CEO and co-founder of Toggle, and I wanted to welcome you to one of many insights we produce on every trading day. If you'd like to see more of them, please subscribe to our YouTube channel or check us out on toggle.global, where you can also test drive the Toggle Copilot, the first intelligent investment dashboard. The focus today is going to be on a company called Ingles, which is a regional supermarket chain that many of you might not have traded or heard of before. But Toggle is actually highlighting that it's showing a very interesting pattern of a decline in realized volatility, which historically, and this is based on about 36 similar episodes in the past, preceded a rally of 7.5% or just shy of percent over the following 6 months. As you can see here, the starting point here is 43.25, and the median projection based on this historical parallel would actually see it rise to 48.18. Again, dropping below 40.79 means that the odds of this paradigm still falling within the kind of likely outcomes based on the parallel has greatly diminished. And so this is usually the point where it's worth reevaluating the position in this particular stock. Now, what I want to highlight is just the recurrence and frequency of these patterns in the past. So you can see that this is the moment. These are all of the past moments when volatility had similarly declined, and the subsequent rises in prices. You can see some of them were actually really quite extreme. The better way to see this is the last chart, where we typically show you the results of our back tests. And what you can see here is the very vast majority of the outcomes lying kind of here between the 10 and 40%, some outliers even as high as 60%. And the downside mostly contain around 20%, occasionally a 30 to 40% drop. So the bottom line is this definitely has the feel of a more barbelled nature of returns. There could be potentially some pretty meaningful drops to the downside. So the red line is definitely something that's well worth using as a reevaluation point so that the stock doesn't slide as far down. But overall still looks quite a compelling risk reward given the accuracy that you're seeing scenario. So much for the stock today. In our daily brief, we also discuss the comparisons that you might occasionally see of today's market with the 1920s, and we discuss a little bit why the data actually don't really support that kind of parallel. Anyway, check it out. If you get the daily brief, look it up in your mailbox. If you don't, you can sign up on toggle.global. Thanks again. We'll talk to you again tomorrow.